All right, let's get ready to have our minds, well, slightly reset. By the joy end of market technicians, we have an expert, Louise Yamada of Louise Yamada Technical Research Advisors. Louise, always a pleasure. Thank you for coming to Bloomberg.
My pleasure on this snowy day.
Exactly, yeah. And I'm so glad you made it through because you're going to reset our minds, right? You're talking about how if anyone has been looking at what's happening in the bond market, you're going to have to get ready for something that we haven't seen in a long time. Give us a hint. What's going on?
And you have to have a little bit of a longer-term perspective. There's so much daily noise of trading going on. But just as in 2000, we tried to educate our clients to the possibility of a new structural bear market in equities, now we're starting to at least create the mindset for a shift out of this 29-year bull market for bonds. That means falling yields, rising prices, because as we know, bond price and yield move inversely. But if we go back and look at the 200-plus year history of interest rates in this country, bond cycles have been long, 22 to 37 years. So we're 29, 30 years into this. And interest rates on the short end can't get much lower and are just starting perhaps to tick up. I think that one of the things to focus on is not if the shift is going to occur, but how. And there are differences in the reversals. Rising interest rate cycles historically have reversed very quickly, like an inverted V. Falling interest rate cycles have taken 2 to 14 years. They've been slow, multi-year transitional affairs, saucer-like bottoms. And one of the reasons we perceived in doing the study is because all of those periods carried deflationary pressures. So you couldn't raise interest rates, just like the Fed has not been able to raise interest rates. So we're still in that transitional phase. And unless rates go through 5.5%, we are still in the bull market for bonds. But what we're seeing at the long end is something very different from the short end, and that would be the 30-year Treasury yield, which has a very symmetrical, beautiful head and shoulder bottom formation, suggesting at some point when that breaks through 4.8% that we will be seeing the long end begin to move up. And it's probably at the same time that we'll have more little deflationary bubbles and the short end will go down. The 2-year note is well under its moving averages, where the 30-year is above its moving averages and looking quite a bit stronger. We've looked at it as the canary in the mine, so to speak.
That gives you that telltale sign, right?
That's
but you're saying pay attention to what's happening at the very long end of the curve.
Because part of that really relates to foreigners buying our debt. And if they no longer want to buy our debt, as China has cut back, as Russia has cut out, and then you have the problem of having to offer a higher rate to get someone to buy. And I know it's almost been like the Fed and the Treasury dog chasing its tail, because the Treasury issued 900 million long bonds, and who bought them? The Fed bought 500 of them.
Yeah, it's a little bit of a cycle, right? Yeah, exactly, right.
I mean, it's not really going to somebody. But one of the principles, obviously, of the inverse relationship is as and when interest rates begin to rise, the price of the bonds will decline. And it concerns me that people be educated to this, because so many people are struggling to find yield, that right at the moment when interest rates are about to reverse and go up, you're right.
Everyone has shifted into bond funds.
Shifting into bonds, just like they shifted into technology just before the 2000 peak. So I'm more or less trying to give a little bit of an education as to how this happens and why, and that maybe you use backup in rates now to eliminate longer positions and position yourself more mid to shorter.
All right, so if you position yourself mid to shorter, that also I'm going to assume here that it means that if you're going to pull some money out, that all of the information that we get about the mid and the short term isn't a little bit of a fake out, because it's not a long-term positioning. It's not as if people are saying, yes, I'm going to keep my money in short-term money market instruments or in the short end of the yield curve for a long time. It's just, I don't really know what to do with it right now. Let's just park it someplace safe, where then I'll make a decision maybe when rates start to rise. That's when I'll start to go in.
Well, that's true too, but the other aspect of getting out of the long end, which may start to see rates rise, you're not stuck in it for 30 years, while rates may go to 7% at the long end over the next several years or decade or whatever it's going to be. Whereas if you were to shorten up and take a 3 or a 5, you know you're going to get your money back in the 3 to 5 years, and then you can upgrade to a higher yield at a moderate time frame.
All right.